Hi, this is Nick Papanicolaou, VP of Brand and Business Development for New Brand Ventures at Pernod Ricard USA. And I want to continue with the valuation discussion in Valuation 201. So last time we talked a little bit about some of the transaction multiples. So this was the multiple of sales, the multiple of EBITDA, or the multiple of cap. Those are what an investment banker would call transaction multiples. They are based on previous or prior transactions, looking at how similar or different your brand or transaction or partnership is compared to those, and determining whether and why you should be above or below that transaction multiple. Another one that investment bankers look at is called trading multiples. These are now looking at the public companies and what they are, quote unquote, trading at. So again, because public companies disclose all kinds of financial information, you can also look at price or enterprise value to sales. You can look at multiples of EBITDA, of cap, etc. But you also have the benefit of looking at balance sheet and looking at their assets and creating valuations based on that. And just like with transaction multiples, with trading multiples, there should be a good reason to believe why your brand or your valuation should be higher or lower than the public companies and what they are trading at. And the last one, which I think probably generates the most excitement and confusion, is called discounted cash flow, or DCF. Quite frankly, I do not like this methodology at all, but it is pretty commonly used in investment banks. And the idea is to project forward your cash flows, discount them back to today's value, and also project forward what something called the terminal value, what the terminal value of the company is at the end of that 10-year cash flow period, and discount that back to today. So you're essentially taking a present value, today's value, of value created in the future. The reason I don't like it is because there are so many assumptions and inputs that go into it that you can basically have a DCF say whatever you want based on changing different assumptions just a little bit here and there. That's one reason. The second reason I don't like it, particularly for early stage brands, or what we're calling the craft spirits movement, is that a lot of brands in the early stages are not actually cash flow positive. So it's hard to discount negative cash flows back to today's value, or today's time. You will get a negative value. So that tends not to work as well. So those are the three most commonly used investment banking methodologies: transaction comparables, trading comparables, and discounted cash flow analyses. I think there are other methodologies to be used as well, and I look forward to discussing those with you in Valuation 301. Thanks so much.